Exactly. You're very consistent. You run your numbers very well. You're a young guy. So Matt's got a little bit of a presentation to start us off tonight.
Actually, I'm just going to do a really quick presentation, just kind of on some of the basic concepts behind debt and equity investing or qualification. This isn't meant to be a fully all-encompassing or a completely exhaustive presentation. I'm just going to try and crank out a 15-minute presentation here for you. 10,000-foot level view of debt and equity investing. So first of all, let's just cover why understanding this is important. Because at the end of the day, you could just turn around and hand over all your money to an investment advisor. But you got to remember that no matter what, you're always going to care more about your money than anyone else. At the end of the day, it's your money. It should matter more to you than anyone else. As far as understanding debt and equity investing, essentially the fundamentals and the rationale behind what makes a good investment for a debt or equity investment is going to be very similar to the same principles and core concepts for a small business or a rental property or whatever the case may be. Whatever type of investment you're looking at, you're still going to be looking to get a return based off of your assets. And so a lot of the fundamentals that you're going to learn through learning about equity investing, such as like how to read cash flow, P&Ls, that's going to be really important regardless. And essentially it's also just going to give you a stronger understanding of both the macro and microeconomic factors that are just going on around us at all times. It's shocking to me that money's a taboo subject because it almost drives every aspect of our lives, and it's silly to let it have that power over you where it becomes a taboo subject, where you're not willing to discuss it, where you're not willing to learn about it. And finally, you're here because there's a financial independence retire early group. So if you actually do want to FIRE, if you want to reach financial independence, you're probably going to need some sort of return off of your assets that you've saved up, unless you're just going to save a giant mountain of cash and spend it. So figuring out a way to create passive income is going to be very important to actually executing your financial independence, retiring early. And so essentially that's why learning about debt and equity investment is important. And so then essentially, let's just go through at a really high level what debt and equity investments are. So debt is essentially just going to be like loans or bonds. Think of it that way. It's essentially, it's an obligation. And then equity is going to be like an actual fractional ownership in a business, or at least it's going to be some sort of unit or share based on like some sort of index fund or mutual fund. And then there's also hybrid investments. And so hybrid's going to have aspects that are both debt and equity. So that's essentially going to be like convertible debt. And so convertible debt is essentially a loan that you can actually convert into a fractional ownership of whatever the business is or whatever the company is. And as well, there's preferred shares, which essentially pay a much more fixed income versus what traditionally is assumed with equity investments. And so again, we're just taking really the 10,000-foot view here, but so debt can be essentially individual, business, or government. And so you can literally loan your cousin Jimmy $10 and he'll pay you back $15 a week today. Or you could be buying bonds or directly loaning to a business. And you can also buy like government debt. So something that's going to be insured by maybe the provincial or federal level. And then equity, essentially, the way I'm going to break it out here is there's essentially two types of equity. There's private or public. And so public's what a lot of us think of when we think of shares and stocks. So that's your, units in a trust, whether that's a REIT or some other sort of business, whether it's actual shares in, blue chip company, one of the big banks, all that stuff. And then so private's essentially just going to be shares in a private company. So maybe, it's your Uncle Bob's plumbing company and you own 50% stake in that because you gave him initial capital funding to get him going. And so essentially, how do these assets actually end up generating a return? Well, essentially there's going to be three approaches to it. It's either going to be interest, so like on your debt or bonds, you'll get just paid interest, or dividends. And so dividends essentially is a company paying you out part of the earnings from that business. So essentially just think of it as a share or a stock in a company is just a tiny fraction of the ownership in that business, and when that business makes money, it's going to pay out, and that payout is in the form of a dividend. And then finally, how can you actually like own these assets? So there's really just two ways to own these assets. So there's paper, which is direct, so you can literally own it in your name. So for example, I own shares in some of the bigger banks and some blue chip companies in Canada, and so that's actually in my name. Or you can own it in a brokerage account. And so brokerage account is what most people are familiar with. That's where maybe you use whatever, TD, RBC, CIBC, you have a discount brokerage account where you're buying shares, but it's actually in the street's name. And all that means is it never actually gets transferred over to your name. So like the stock certificate never actually carries your name on it. It'll just be held in trust by CIBC or by RBC. And so essentially the ways then that we can own it, if we're going to own it in the street's name in a brokerage account, is either just like a personal brokerage account, so probably a discount brokerage because that's going to save you money on the transaction costs. But essentially all that is just like an account with, essentially you just have it with like a bank, right? One of the big banks, or it could be Quest Trade or all sorts of other discount brokerages. Then you can also have it like in a tax advantage or a tax deferred account. And so that's going to be the RSP or a LIRA or a TFSA. And so an RSP, I think a lot of people are at least fundamentally familiar with it. That's Registered Retirement Savings Plan. And a LIRA essentially is just a locked in retirement account. And so often the LIRA you're going to get through an employer. And an RSP, essentially anyone has access to since you're over 18. It's based on a percentage of your income. You can look up all that information on the CRA website. And then TFSA to me is probably the most powerful type of account we have right now in Canada for growing your wealth, particularly if you're looking to retire at a young age. And the reason for that is it's not a tax deferred account like an RSP where eventually you're going to end up having to pay tax on those holdings. This, unless the government repeals it, this is forever. This is for life. And so you can just have that continue to grow and compound over time. And the saddest thing to me right now is a lot of the big banks and stuff essentially push a TFSA as a high interest savings account, as a temporary savings account. And it's the exact opposite of what you should be doing. You should actually be investing for the long term, and a TFSA, you should be trying to grow that contribution room. Sure, you're not going to want to necessarily invest in really high risk assets, because if your value drops fundamentally or it goes to zero, you're going to essentially lose that contribution room. But that being said, if you're able to grow it, all the earnings from that account forever are going to be tax free. And like that to me is just a magic bullet for financial independence. And I think it's really a priority that a lot of people should be making that's often overlooked. And it's just because the banking industry in Canada is doing us a disservice by not really diving deep into how powerful a TFSA can be.
Could you go into what a good strategy would be for a TFSA for directing your funds towards?
Sure.
A little bit.
So like I think as far as so just in general, and I'm going to get to this in a little bit, but investing directly in equities, so like actually buying a share of CIBC or 3M or whatever the company is.
Like a longer term the company that'll be around for quite a while.
Yeah, and so I think like there is a risk with individual people buying direct shares in companies just because it's actually a very complex system, the way our financial reporting is done. I was a financial controller at a publicly traded company, and I feel like I'm barely qualified to read financial statements. And that's not to say that anyone's not capable of it, but it's a skill. It's going to take a lot of time to develop. And so what I would suggest for the average person is something a lot more like the couch potato. And so you can just Google that and you'll find Couch Potato Canada, and a fantastic resource. But essentially some sort of index fund ideally, maybe something that tracks the S&P. It's going to be relatively safe, but it's still going to be growing. So unlike that high interest savings account, your upside is very limited in a high interest savings account, right? You're maybe getting SKs 2%, where ideally in the S&P you should be getting something closer to 7% on like a 10-year horizon. And so essentially there's a nice rule of thumb called the Rule 72. And so essentially what that means is if you take essentially whatever interest rate you're getting and divide it into 72, that'll tell you how many years it'll take to double your money. So let's say if we were in 7% in the S&P, some sort of index fund, it would take 10 years for us to double our money in that TFSA.
Right.
So right now we have about 55,000 in contribution room in our TFSAs. So 10 years from now, if you invest in an S&P index fund and assume the market goes according to the way it always has historically, you could count on maybe now having 100,000 contribution room there. And so that 100,000 now could earn you $7,000 a year, tax-free, and that's forever. And that's so much more powerful than earning that same money in a brokerage account that's just in your name, that's not a tax advantage account. And it's still even so much more powerful than earning that in an RSP. Because when you pull it out, especially if we're retiring at a young age, we're looking at a very long time horizon. So that loss, that being taxed, can really pull back the amount of money we're actually able to execute with. And so essentially, that being said, this is kind of me going off course now, but so the beauty is we still have essentially $11,000, $12,000 threshold for the bare minimum that you can just get paid, right, without paying taxes. Then we could also be earning that $7,000 in our TFSA. So now we're essentially earning $20,000 tax-free. And that's before getting into the sort of benefits that you can get. Essentially, if you optimize your personal situation for taxes, if you were investing in pure, say, Canadian publicly traded companies, you can actually earn up to almost $40,000 in qualified dividends and essentially have no tax hit. So essentially there's a way where we could structure things where you could be earning $50,000 say a year and be completely tax free. And so that's the equivalent of maybe making $70,000 or $80,000 a year before taxes. So that to me is why the TFSA is so powerful. That in conjunction with some of our other tax benefits, you can really start ramping things up. And so I know I'm really going through these tax strategies at a really high level, but that's because this wasn't supposed to be a tax seminar. But there's all sorts of amazing resources out there where you can find in-depth analysis of guys that are going through, that are not only just talking about the theory, but they're actually implementing it for themselves. And so just moving on then, so we essentially already kind of covered this, but
you want to grab that?
The type of debt investments, so we're talking bonds, loans, and now we also have a new thing, peer lending. So Lending Tree and all these other sort of peer-to-peer lending options, which it's still in its infancy, so I certainly wouldn't want to dedicate a significant portion of my asset allocation to it. But it is very interesting, and it's really making both lending and borrowing a lot more democratic in the market. It's giving access to capital to a lot broader of a group of people, and it's also allowing us to lend out to a much broader group of people as well. And so there's great opportunities to really diversify there. Then there's hybrid investments, and so I think these two are really misunderstood. Garth Turner on his blog Greater Fool goes into great depth about Canadian bank preferred shares, and they can be a very powerful investment class too. Again, though, it's one of those things where you are going to have to spend some time and really learn about it to get comfort around it. And again, it's just a skill you need to develop. And then equity, so that's shares or stocks or units in some sort of trust, or essentially I'm going to also classify that as funds. So whether it's an index or a mutual fund, something that's essentially tracking or pegged to an equity fund. And then so all that being said, I think the most important thing is just start learning right away. It's never going to hurt you to learn these things. So there's great books, blogs, online courses, and forums. And so I'm specifically going to really recommend people consider checking out the Canadian Money Forum. And so it's just a fantastic group of, it's mainly, I'm going to say middle-aged to retirees that are actually living it. They're executing a lot of these plans. So they're using things like the Smith maneuver or cash damming, or this TFSA optimization strategies that I'm sort of talking about here. And what's great about that is they're really grounding it in their personal experience. And I think that's what a lot of us come out to these meetups for. We can learn all this stuff online, but it's actually meeting people that are actually doing it, or meeting people that are trying to do it, meeting people that are learning about it, being able to bounce ideas off of each other. That's what's really powerful about these in-person meetups, in my opinion. And then so essentially, let's say you want to get started investing directly into equities or debt. How can you get started? Well, if you got no money, you're not actually going to be able to invest in anything. But there's all kinds of great simulators out there. There's all kinds of great simulators, or you can essentially create like a play money portfolio and still track it. And then if you just have a small amount of money, let's say $1 to $1,000, you can go the high interest savings account, which is that HISA. There's something called drip investing, and so what I'm going to be talking about here is it's actually like the original drip investing, so it's not synthetic. It's where you're actually going to own the stock in your name, not in the street's name. And so essentially there's a great resource, dripinvesting.com, and on there you can just reach out to other people. You pay them $10 and they'll give you a certificate in your name. And the beauty of that is with all these, you deal with directly with the brokerage or the transfer agent. So it's going to be computer share or Canadian stock transfer in Canada. But you're never going to have transaction fees after that initial $10. So for example, I bought a share of BMO like 4 or 5 years ago. Essentially just mail a guy a check for $55, which was the cost of a BMO share at the time, plus $10 for his hassle of filling out the paperwork. And then I can buy all the BMO shares I want in my name for free, directly from the transfer agent. So rather than paying that, whether it's $7, $9, or $30 commission, depending on what your discount brokerage offers, you're able to just directly buy it from the company through their transfer agent. And you can essentially do that with a large quantity of blue chip stocks in Canada. So I'm going to say there's probably about 40 to 50 you can do with, as well as a few trusts. And then in addition to that, pure lending. A lot of the pure lending websites have essentially no minimum investment, or if they do, it's something small like $100 or $500. And so again, that's really going to let you kind of dip your feet into the idea of starting investing. And the value there is, I know for myself, I understood a lot of the theory, but as far as actually sitting down and reading the financial statements of Bank of Montreal or CIBC or whoever, I never was actually interested in doing that until I actually had some skin in the game. And so these little strategies, even if you're only investing a token amount, whether it's $50, $500, or $1,000, it's still, the moment you start actually having money in the game, and the moment you see a gain or a loss, even if it's just on paper, that's really powerful. I think for a lot of us, it'll really get you way more engaged with it. Like, why do I have that gain? Why did I lose that money? And then if you got $1,000 plus, I'd recommend considering starting a brokerage account through a discount broker. Again, you can probably do that at any of the big 5 banks or through a Quest Trade or similar type entity. And then so in addition to that, if you actually have large sums of money but you're not overly financially savvy, and by that I mean if you don't know what a PE ratio is, or you don't understand how to read a cash flow, you've never read the notes on financial statements, I don't recommend allocating a significant portion of your personal assets to directly invest in equities. I'm going to suggest you invest in some sort of ETF, index fund, or use a robo-advisor. And so all those, again, you can Google the terms and really get into deep level, but essentially I'm going to call those D-series funds. And so what that means is they have a really low MER. And so from the last meetup, we just talked about it at a high level, but an MER is like a management expense ratio. And so that's essentially what the company that's investing your money on your behalf is charging you for the privilege. And so a high ratio would be something like 2%. That's what you're going to see in a lot of A-series funds, so expensive mutual funds, which are often the ones that the nice person at the bank's going to push on you. Versus an index fund could be as low as 0.2%, could even be 0.1% of your funds. And so compounded over 10 years or more, that has a significant impact on your returns. And the thing is that MER, it's based on the total assets, so it's not the income that's earned. So let's say you started off with $100 year one. At the end of year one, the market went bad. It dropped in half. You're at $50 now. You're still going to get charged that MER of 2%. So they're actually going to take $1 from you now. So now you have $49 versus the 100. Whereas, you know, if we had the 0.1%, we'd have $49.9 versus our 48. And so essentially, that's how I'm going to recommend a lot of people consider getting started and investing in debt and equity. And now just as some really nice, easy, actionable items you can do, some low-hanging fruit that almost all of us should at least consider doing if you have the options. Pay off high-interest debt before investing. If you have credit card debt or a high-interest like line of credit, say you're paying whatever, 7, 8, 10, 19% on some sort of debt, that's the best investment you can make, is paying that down versus investing in stocks. That's a guaranteed return after tax of whatever your interest rate is. And so that's really powerful, yeah.
How would you lump in mortgages with that?
So mortgages, I'm going to call that, at least in most cases for most people, unless they had to go through a hard money lender, they're going to be paying a very low interest rate. So it's going to be maybe 3%, maybe 2%, maybe 5%. But I'm going to call that a low interest rate. And so presumably if we can track the S&P and get somewhere around 7% return, it can either be a break even or better. So I'm going to say that's really up to the person then. I know a lot of people personally have an avoidance towards debt, and if that's a priority of yours, I think it's fine to focus on paying down the debt as fast as possible. I don't think it's the most optimized solution if you're trying to reach financial independence as fast as possible, but if it gives you that sleep factor at night, it's worth it in my opinion. And then so as far as other low-hanging fruit, if your employer does any sort of matching program with your RSPs, you need to do that. You need to max out that match every time. That's a guaranteed 100% return. There's nothing better in this world than a guaranteed 100% return. So you need to make sure you're doing that. I personally, it would be the first thing I was focusing on if I was developing a personal budget. If I had an employer match, I'd be making sure I max that out. And so if you're not familiar with what that means, essentially just some employers will offer, if you put 2% of your salary into the group RSP plan, they'll match that 2% and give you another 2% of the value of your salary into that RSP plan. There's usually stipulations like you got to stick around for X number of years or whatever. Still the best guaranteed return you can get. And then finally, just essentially go through and audit what you're currently invested in. Do you have an old mutual fund from a previous employer that's in a 2.5% MER fund? Because if so, sell that, and you can probably find almost an identical mirrored index fund that will accomplish the exact same thing, but at a fraction of the MER cost. And so again, dropping from a 2% to a 0.2, that's a guaranteed 1.8% return after taxes. There's just no reason not to try and optimize in that sense. And so yeah, so that's pretty much it. It's really hot in here. We'll probably do our introductions next and stuff, but just also I brought 4 copies of the book Early Retirement Extreme. I consider it my Bible. I think it's one of the best books written on the subject matter. So if anyone wants to borrow it, feel free to. And just ideally, if you can bring it back to the next meetup so other people can have it, that'd be awesome. But yeah.